One person said you should cut by another 0.25%, so by 0.5% in total.
No prizes for
And
guessing who
that
that
was
was.
somebody who's put their name forward for being chairman of the Fed, isn't it?
It is. One of Trump's mates.
friends. Oh,
Yeah.
that's surprising, isn't it?
Trump's employee in the White House. Let's not forget that.
So this difference between the corporate yield and the government yield is something called the spread. And the spread is tradable. You want to buy corporate bonds when the spread is wide. You want to sell corporate bonds when the spread is tight. Today's markets, the spreads are very tight, the tightest they have been since the great financial crisis in 2008.
We have crossed that target of up 10% on the year. We have made 10.6% so far after 12 weeks.
Well, this is where I'm going to actually bang the table at risk of getting a red card here and saying, come on guys, why have you got short-dated gilts? Yes, they have defensive characteristics. I can give you similar defensive characteristics, but some more lovely income every year.
The only other thing I wanted to say was, Rich, when are you going to go bullish?
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 17 of the UK's fastest growing investment podcast. It is The Art of Investing. This week, we bring you a very special guest. And this episode is for you. If you think that corporate bond is when 007 used to work for Universal Exports. Along with Chris Fellingham, Mark Holden. Ladies and gentlemen, I introduce, his name is Bowie, Chris Bowie. Welcome to the podcast.
Thanks for having me.
So, give us a little bit of background then, Chris. How did you end up knowing these two?
Well, I've worked in the bond market for 30 years. I've done a range of roles. I've done government bonds. I've done corporate bonds. Before that, I actually had a proper job. I worked as a programmer for 3 years. But I met Chairman Chris here.
Chairman Chris, it sounds like a Chinese Politburo, doesn't it? That's why I'm trying to run it.
So I worked for Chris a few years ago. And when he became my boss, I was living and working in Glasgow. And I credit Chris with getting me to see the light because he invited me to move to London with my team, which I did. And of course, coming from Glasgow to London, there's a bit more sunlight in London. So clearly, I'm seeing the light now.
Well, the markets have seen the light this week as well. Yet again, go on, Mr. Bull. Give us the spice market update.
Thanks, Rich. I thought you'd never ask. Well, yes, we're into week 5 of the government slowdown or shutdown. It's the second longest on record now. No sign of it being fixed. So we've talked about it maybe lasting until the end of November and Thanksgiving sort of time. But this week it's been all about the Federal Reserve. Have cut interest rates and the Magnificent Seven have started reporting en masse. They started last night. On a more positive front, crypto has basically steadied up a bit this week. Hasn't really gone down much, but hasn't gone up yet. But what is alive and well is the taco trade. Remember that Trump always chickens out, is alive and well. He's doing a whistle-stop tour around Asia that's going to end up this weekend in South Korea for the Asia-Pacific Economic Cooperation, APAC, conference and summit. But as he's been going around Asia, he's been giving away freebies, reining back some of the tariffs. But most importantly, at the beginning of the week, he said that there was a new framework for China and the US to do a trade deal. And hopefully that will be signed off this weekend. Because of that, all equity markets pretty much around the world are up to their all-time highs, Europe being the exception, funny old game. But even the FTSE's eked out another high. All the US markets have absolutely flown. And part of that has been fueled as well by the fact that the chief executive, Jensen Huang of Nvidia, came out at a conference in Washington earlier in the week and said that he expected his business that sells chips into the cloud and to the computing side is basically potentially going to be double what analysts were expecting. So they're going to generate about $500 billion of revenue potentially next year. And that's 50% more than most analysts had in their books. So the shares have had a great sort of end to the week. They're up about 10%. And it's taken Nvidia now to being a $5 trillion market capitalization company.
Wow.
Yeah.
And that's $1 trillion ahead of the next nearest, which is Microsoft and Apple. And both of which of those hit all-time highs again this week as well.
And how much is that up in a couple of years? Were they even $1 trillion a couple of years ago?
No. I mean, it's been going for it's knocking on for 2 years now that they've had a really big run. But yeah, about 18 months ago, it really started to motor. And there's no sign of it slowing down. And they don't have results until mid-November. But by saying what he has done at this conference, obviously the analysts are getting super excited about it. Now, we have had some other Magnificent Seven results this week, and they've not all been good. You'll be pleased. Rich will be pleased.
What's going on?
Rich will be pleased.
Excuse me. We got excited there, didn't we? Yellow card straight off.
Yes, thanks. I'll give you this, Rich. I'll give you this crumb. Meta, who owned Facebook, were down about 7% after their results last night, which for us was Wednesday night.
Scaring everybody with their huge CapEx spending to Nvidia.
Yeah, well, it's a nice virtuous circle. These things can go up. Keep feeding it. Microsoft was a little disappointing, but although both of them actually beat results, it's just the outlook statements were a bit more sort of cautious than people thought. But on the other side, Alphabet, who own Google, were up about 7%, and they reported good results. Tonight, we get Amazon, the world's biggest retailer. So if you're not getting enough packages, you better start ordering now because the market seems to think they're pretty good. Elsewhere in the reporting season, as you know, we're into the busiest week this week of the global reporting for companies. On the whole, they've been very good. So 84% of companies are beating expectations against an average of about 70% over the last 5 or 10 years. So that's good for this time of year. Next have had very good results in the UK. The European banks done well, Ford, Intel, PayPal. But on the bad side, there's a gold mining company called Newmont, who made great profits, but they've been slightly sort of mining down the grades of ore that they do, which basically is one way of trying to keep your profits lower than expected, so you don't mine the really rich veins of gold. They were a bit weaker than expected.
And we've probably got exposure to those in the World Mining Trust, don't we?
We have. And we know that the US government are busy doing deals with other companies and buying sort of specific minerals that they want to get security on over the years. They also announced that they're going to invest $80 billion in nuclear facilities or reopening some of the nuclear power plants around the US, including 3 Mile Island, which we've talked about before, that Microsoft have done a deal with to reopen that to help fuel the electricity for the data centers, which is huge. And there's an estimate that at the moment, data centers are using about 4 to 5% of all the US electricity generated. But within 5 years, that's expected to go to over 10%. So there's a huge demand growth in electricity that's coming through. And so you'll see more of this sort of thing. Japan, as you'll see when we talk about the portfolio, has had a very good week again this week. As we know, Sane Tananichi, the new prime minister, is doing great things and talking things up. And so the equity market smashed through recent highs. But interestingly as well, the Japanese government bonds, which are normally some of the lowest rated and lowest yielding in the world, basically the yield on those 10-year Japanese government bonds exceeded the S&P yield, which is about 1.7%. That's the first time in 20 years that you can buy Japanese bonds at greater yield than the S&P 500.
That sounds very bearish to me, Chris. What do you think?
Absolutely. Japan's been a really funny story this year. Inflation's out of the bag. Bond yields have sold off aggressively. We've had a lot of what we would call yield curve steepening, where the longer dated bonds have seen their yields rise much quicker than the shorter dated bonds, bringing quite devastating losses to JGB, Japanese government bond owners. This is the first time in my career I've seen this, and that's 30 years it's taken for a sell-off of this magnitude.
It's not the first time I've ever seen it because I'm a bit older than you. But it is really important for global liquidity that Japanese bond yields are picking up, because Japan is one of the great savers of the world, and they have exported the money that they're saving into other markets for years and years and years and years and years. And now their own bond market is starting to provide an alternative. So if you remember when we had Stuart Thompson on, we talked about the competition for capital and how as other things start becoming more attractive, that might take money away from areas where it's been spent up until now. So we'll need to watch carefully what happens with these Japanese bond yields. Still, I would say they're too low a level to worry us too much. And the rest of the world bond markets are behaving themselves still as well. But this is something to watch.
So just to spell that out, there is a chance that Japanese investors that have international holdings, so maybe long the S&P 500 or US Treasuries, would be more tempted to bring the money back home and invest in their domestic market.
Yeah, as yields go up, obviously in their own market, they don't have currency risk and they have the safety and security of their own government issuance, because governments can always raise taxes more, so they can always repay their debt. So at the end of the day, it will be when it gets to a yield level which is attractive relative to these other things. Now, I would argue 1.7% isn't particularly attractive. When the S&P is going up this week alone, it's gone up over 3%. So it's not really that attractive. But if we then look at where 10-year US yields are, 10-year UK yields are, 10-year European yields, when they get to a level that people start to think, do you know what? I'm going to buy those because I get safety there rather than put my money in risk assets. That's when we need to start to get worried. But we're not seeing that at the moment. This is the story that hasn't happened this year. Everybody's been concerned that bond yields are going to push up. Bond yields have actually gone down, which has helped, therefore, the equity markets continue this wonderful bull run that they've been on. And my comments for this week are just look at how beautiful the bull market is. I mean, whether you've been totally committed to it or not, Rich, it's wonderful to see how when people want to believe the good things, they believe it. And if we just take those comments that Spice said right at the start on Trump, it's the old grand old Duke of York nursery rhyme. He marches them up to the top of the hill and he marches them down again. So he tells you all, I've got problems with China. I'm going to put my tariffs up. Market sells off a bit, but actually doesn't sell off very much at all. The market then spends the next few days saying he'll give in. He then gives in. So actually, there's no change and the market's go up a load. That's a bull market. And you just got to recognize it. You got to admire it. It's beautiful. Don't get too complacent about it, but it's beautiful.
Chris, did I not see a picture that you produced?
That's right. A recent investor roadshow, I had an AI image of Trump as the Grand Old Duke of York, marching his troops up the hill and then down the other side.
It's the art of the deal.
And he's a good deal maker. And equity markets certainly like him, which is good. We talked about oil last week, if you remember, in quite a lot of detail. And for those of you who are interested in it, there is an OPEC meeting. Remember, OPEC is the Organization of Petroleum Exporting Countries. And they have a meeting this Sunday, and they're expected, as we suggested, to slightly nudge up their production again. And the oil prices come back a little bit from having had an 8% rise of the week before. Just ahead of that, in anticipation of that. I wanted to talk about oil a little bit again today because the FT this week have run an article which suggests that Rachel from Accounts is looking to potentially scrap the windfall tax that she'd put in place and added to last year in the budget on the North Sea oil, because we said that the oil companies in the North Sea are taxed so heavily, in fact 78%, that they're just totally disincentivized from doing any new production or exploration, which is hurting the UK economy. Fools that they are. So we'll see if the FT have got the right nudge on that one. But it would be good. But I wouldn't expect the production to go racing up very quickly, because these things will take 3-5 years to get any sort of production increases. She is insisting that the only reason she would cut this tax is if those companies do increase their production and exploration. So we'll see.
Yeah, I think in fairness to Rachel, I'm being a bit more respectful, our Chancellor of the Exchequer. She added taxes that were already high anyway. But I think it is noticeable that there seems to be a view, and we've talked about it over the last couple of weeks, that they finally realised that if they don't get growth going, they've got a real problem. And therefore, they're trying everything they possibly can to give the impression that they've seen the light and that they're going to do something about it. I think it's quite interesting that the stories run the FT, which is normally a very good source of stories, and says, that she's going to cut this tax if people promise that they're going to invest more money and try to get growth going. So she can then go to the Office of Budget Responsibility, the OBR, and say, look, I've got more growth. Don't put my requirement up too high. I mean, we're going to talk about more about this in the next few weeks in the budget. But it seems to me to be really interesting how the mood music is changing and supports our purchase last week of the smaller companies' UK equities, although they've not done the best job over the last week.
I think, talk about the budget. I think international investors are already beginning to position themselves for potentially a disappointing budget as far as maybe financing, etc. Because the pound sterling has fallen this week is noticeably against all the other major currencies, and it's down about 1%. And that may be international investors just pulling back a bit from the UK. Now, of course, remember the FTSE 100 earns about 85% of its earnings and its revenues from abroad, from overseas. And so when the pound goes down, profits in UK companies tend to go up on average. So you could say profits could be upgraded by about 1% this week in the FTSE 100, and the FTSE 100's hit a new all-time high. So that's great.
So that takes us perfectly into this week's portfolio review. For those of you watching on YouTube, we now put the slide up and you can see week 12. Gentlemen, a very well done, especially you, Mr. Bull, because we have crossed that target of up 10% on the year. We have made 10.6% so far after 12 weeks.
It's been a fantastic week. I mean, it really has. We had our first down week last week, or first major down week last week. And to just see how much has been reversed, it just shows you how the bull market is really now starting to push on with vengeance. Our best return over the week was the VanEck Crypto and Blockchain Innovators, having had a bad week the week before, has done a very good week this week. Copper's done very well as well, and NASDAQ.
And that copper is our example of where a dollar asset we've brought back into pounds. So copper, is up 4% on the week, but then we've also got 2.5% from the GBP coming lower.
And NASDAQ's done very well because it's got Nvidia as its biggest company, as it is in the S&P 500. But in NASDAQ, it's about 13% of the NASDAQ as a whole now, Nvidia, at a 5 trillion market cap.
And it's also dollar asset as well. So that's helped with the currency. I mean, the Nikkei, what a great performance from the Nikkei. I mean, we've, since inception, that's up 20%. I mean, that's tremendous. Since we incepted the fund, I don't mean since the Japanese bond, the Japanese market ever started. Since we started the fund, it's up 20%. I mean, that is unbelievable.
And close behind it, the World Mining Trust. The World Mining Trust now up 17.5% after a 5% performance on the week. That's despite gold weakness and those numbers from Newmont. So, yeah, overall
a good time. Let's just have a look at the negatives just quickly. MSCI India, just a small bit down, but nothing really. Vanguard FTSE 250, we talked about already. We're taking a view that we're going to get some good news in the budget for companies in the UK. I think it will struggle between now and the budget. It's everybody's favourite short, as Spice just said. Everyone will be trying to pull that down before the budget to try to position themselves, but I think we're right to be in there. And then you've got cash, and we've got this holding in iShares UK gilts, 0 to 5 year, which I think will be very good for us to talk about today because we're talking to a corporate bond expert. The only other thing that I wanted to say was, Rich, when are you going to go bullish? Because, given your bearishness and how the markets are going well, I think that might be a good trigger point for when we should start worrying that everybody's starting to change their view. Is that an unfair question, Rich?
I tell you, you forget I'm extremely bullish on the FTSE 100, extremely bullish on the Nikkei and the miners. Somewhere down there in mid-pack, I see S&P 500. I mean, what even is that? It's benefited from the GBP. But it is interesting this week because, of course, last night we had the Federal Reserve. These prices are taken on a Wednesday close.
Right.
So just for everybody that wonders, where do the numbers get locked in? On a Wednesday night, before we record the podcast on a Thursday, we take the latest figures. And if we make any changes, then Chairman was very, very strict. We cannot make changes until after the podcast is released. So our buys and sells are always from a Friday night on the close after the podcast has come out. Last night, Spice, we had the Federal Reserve interest rate decision. Do you think that the after effects of this, when we see people take an evening to think about it and come back in today, do you think that's going to have any effect on markets this week?
I think it's marginal. I mean, to be fair, the Federal Reserve cut by 0.25% or 25 basis points, as we say in the city. That was widely expected. There was a 98% probability of that happening. And then everyone was expecting that there was a 90% plus chance of another 25 basis point cut in December, or 0.25%. Now, because of what the Federal Reserve said in the press conference afterwards, that probability fell from over 90% down to 70% for December, which is the first time we've seen quite a big move like that. And the initial moves of the US equity markets was to sell off a bit. They sort of fell about 0.5% from where they were trading beforehand into the close, and overnight they've steadied, and so we're opening about unchanged today. And that's not surprising. Some of the things that sort of made people nervous was that there was a split between those who wanted to cut the interest rates as expected. One person said you should cut by another 0.25%, so by 0.5% in total.
No prizes for
And
guessing
that
who that was.
somebody who's put their name forward for being chairman of the Fed, isn't it?
It is. One of Trump's mates.
friends. Oh, that's surprising, isn't it?
Trump's employee in the White House. Let's not forget that.
But there was also a member who clearly doesn't want a job in the next round, who voted for no cut.
It was very clear. Look, Powell came out in the press conference, and his one mission in that press conference was to push back on this idea that it was a guarantee that you would get a cut in December. And that's what the market was pricing in, because the market is priced for perfection. However, he said, by no means have we decided what to do on December's rate decision. And in actual fact, because of the government shutdown, if you're driving in foggy weather, then the best idea is to slow down. And so that was a very clear message to the market. There is only a 50-50 chance in December, whether they cut or not. You would think that would have rocked the confidence in this S&P 500 a little bit.
Well, as I say, I think it's marginal, because you might slow down when you're driving in fog, but when the fog clears, you can re-accelerate, is all I'll say.
Well, only if the jobs numbers are, as you believe, very weak, and we're actually going into a US jobs recession. So if the jobs numbers are actually fine, and that's what he pointed to last night, he said, we don't see any indications that the jobs situation is getting worse and worse.
I disagree with you there. I beg to differ. He basically said that he was seeing increasingly companies laying people off because of AI. He specifically said that when he was asked about it. And he said the underlying non-tariff inflation, so those not related to what Trump did in April, is running towards the 2% target, not at the higher level. So he's basically implying that the inflation that you are seeing at the moment is still transitory and still as a result of the tariffs that Trump put in place in April, but those will come out. But he was also asked about whether he saw any problems in the equity market being overvalued, and he said no. And he pointed to the comparison with the dot-com bubble, where he basically said the trouble with the dot-com bubble is no one had any cash flow, no one had any earnings, they're all making losses. And as we've said a number of times on the podcast, the difference is that this AI expenditure is being funded from internal cash flows. So they're not having to go to banks, they're not having to borrow money from equity guys. And so that is a much different picture to what happened in the dot-com bubble.
Can I just interrupt very slightly there? You know, with the great respect in the world, the Federal Reserve Chairman has not ever had a good call on whether the markets are going up or down. You just have to look at Bernanke, Greenspan, and the whole lot. Them telling me whether the market is expensive or not is going to be, I'm going to chuck that out of the window to start with. No one can deny they were more hawkish yesterday. By hawkish, I mean not expecting as many rate cuts or even rate rises, whereas dovish would be more rate cuts than currently priced into the market. There's no doubt they were a little bit more hawkish. The fact is, does it really matter in the market environment we've got at the moment? It will probably matter when we look back at things. When we look back as to why the market fell at some stage in the future, we'll say, oh, well, that was the first sign there of maybe something. But at the moment, the market's just too strong. The market wants to go up.
Well, there's two markets, though. It's AI and not AI. And not AI is not performing well.
Well, it depends. It depends which markets you're talking about. If you talk about globally, you've got UK doing fine. All right, so in the US, there is that difference. which is why the S&P 500 is probably the safest thing to buy because it's got a bit of everything. But, at the end of the day, the markets are pretty good. Yes, it was a surprising, in my view, hawkish statement from them yesterday. But in the bigger scheme of things, I don't see that as an issue.
We said we would identify when things started to go parabolic. Nvidia's just gone up 10% in 2 days. We saw that happen to gold, and that was the top. It then subsequently has dropped 10%. How parabolic do you want something to go before you turn?
I don't think a 10% move is parabolic at all. You remember, Nvidia's been going side. In fact, the naysayers, such as yourself, were saying that because these big companies that had led the first rise in the markets after April, when you had that massive sort of move up, 20, 30% in the S&P and NASDAQ, after Trump taco traded for the first time after the tariffs, a lot of the companies that led that up, like Nvidia, like Microsoft, Meta, they all had gone sideways for a bit. And so the bears were saying, well, Palantir, they've not taken out their all-time highs, even though the market is. That's not a good sign. That's a sign that the AI bubble's over. Well, Palantir took it out its all-time high again this week. Nvidia has. I think they've just started another move back up to a higher level. So I think that is good for markets. And there is a broadening going out, as we know that.
Now, much as I like to carry on this conversation,
the home builders got hit hard yesterday, so there's not a broadening.
But they're the most
guys. We've had this discussion many times. We will have it further on, I'm sure. Next week, maybe we'll do a little bit more on that. But as chairman, I think let's stick with what we can do at the moment. There are some signs of excess around. There's no doubt about that. But what I think we should now do is talk about corporate bonds, why they're attractive, when they're attractive. Talk to our expert here today and lessen the temperature of the room.
A lot of hot air in here.
Can we turn on the aircon, please? Grow your portfolio with IG. Invest £50 with IG and get a free share bundle worth between £40 and £200. Make your first investment into an ISA, GIA or SIP account before the 30th of November and benefit from commission-free investing as well as 4% variable interest on your cash. Other fees may apply. Terms and conditions found in the show notes or on ig.com/UK. Kickstart your investing journey with IG today. Right, Chris. Well, so really interesting subject because, of course, we have our bond expert and CJ's taken us through govie bonds, but that's just one part of the market, isn't it? So can you give people an introduction, an idea of what is a corporate bond?
Great. Very similar to government bonds in many ways. They pay you an annual income, and at the end of the maturity of the bond, you get your original principal back. You get your £100 back. But with corporate bonds, you have many different flavors. They're just simply loans to companies, big companies and small companies. You have a range of options. If you go for big companies, they're typically called investment grade. They're high quality, very unlikely to default.
A couple of examples of investment grade bonds for people.
Things like Vodafone, like BP, like Next, for example. So companies you'll all be aware of, they'll pay you a nice rate of interest per year and you get your money back at the end. Or you can go into more highly levered companies. Perhaps they've got smaller balance sheets. They're more economically sensitive. They're called high yield. Chris and I are old enough to remember when they were called junk bonds, so they're much riskier. The flip side is you get a much higher coupon, a much higher yield with those bonds, and you can make quite substantial capital gains or losses.
I love the way you refer to them as junk bonds because, most people would, as you say, investment grade or non-investment grade these days. But I started off a long time ago in the market, and I can sit here and say, I was probably one of the first ever buyers of junk bonds in London in 1988. So you're looking back a long time here. I was a young portfolio manager, wet behind my ears still. 1988 was the year of the LBO. Now, for all those people out there, LBO stands for the leveraged buyout. And these three initials were the worst letters that any bond investor could ever hear. Because as Chris has just said, you might have an investment grade portfolio. You might have a company of the day, which you've done all your credit homework on, very high quality, happy to lend them my money. That's wonderful. Some smart aleck in an investment banking department would say, I can do an LBO on them. What I'll do is I'll make them borrow loads and loads more money. They'll still be able to service the debt, but the credit quality of that will go right down. So the value of my bonds, my lovely safe bonds, will now go down in value because they're now a lot more risky. And Spicy over there, my friend over there on the equity side, would be going, hooray, because the takeover's gone at a much higher price and he's made all the money. So in 1988, you did not want to hear that any of the companies that you owned were doing an LBO. I decided, well, if you can't beat them, join them. So this first junk bond issue came along. It was for a firm called RJR Nabisco.
Oh, wow.
And it was the RJR Nabisco stub I bought. RJR Nabisco were bought by KKR, who were, at those days, a very small firm, now one of the absolute titans of the private equity industry. And this was the start of the private equity industry. You know, I've given my thoughts before about private equity. I better not go there now. We'll be ranting and Chris won't be able to say anything.
And what kind of company was RJR, sorry?
RJR was a tobacco firm. Nabisco was a biscuits and foods, and they brought things together with the cash flows from tobacco with the food business. And suddenly somebody said, well, I can bid, I don't know, they traded $60. We can buy this company for $120, leverage up the balance sheet massively. And so I bought some of those bonds. I was really excited. And I was excited because in those days, there was a thing called the Predators Ball in LA. in LA, Los Angeles, clearly. The Predators Ball was the highlight of the annual junk bond jamboree in those days. In the US, organised by a chap called Michael Milken. Now, Michael Milken worked for a firm called Drexel Burnham Lambert. You won't know them anymore, but Drexel Burnham Lambert became the business around junk bonds. Anybody who wanted to do any of these takeovers went to Michael Milken, and he organised this wonderfully conference, and the Predators Ball was the highlight. And I thought, I'm going to get an invite to Predators Ball, and I got an invite. I was really looking forward to going. Unfortunately, Michael Milken was then done for insider trading. The firm went bust, and he went to prison. But what goes around comes around, because Donald Trump in 2020 pardoned him and let him out of jail.
That takes the biscuit.
Donald Trump.
Takes the biscuit.
Thank you very much. But Donald Trump, once again, is the hero of the story for those people.
And it reminds me of, when we worked together, you would often be nervous if I wanted to add even a small amount of high yield into my portfolios. This really explains it all.
I've still got that twitch whenever anyone mentions it.
So it's interesting because he obviously got done for insider dealing, but is it right that in the credit market, there is no such thing as insider dealing in the UK? Or is that still the case?
No, you can still, there's still evidence sometimes of insider dealing. It's more difficult to evidence it in corporate bonds, but they might still do equity trades on the back of it. And a lot of the corporate bonds we buy are from listed companies.
So I remember that if the finance director would come in, if they wanted to raise money through corporate bonds to go to people like yourself to raise money, they'd give you much more information than they would give an equity investor, because you were much more interested in exactly what was going on with the balance sheet and you had to have more reassurance. So that you got a better information than an equity investor would
I would say since 2008, that's completely changed. We get the same public information that everyone does.
And remember in those days, we are talking about a bit back history here, there were a thing called Chinese walls, if you remember. So there had to be a Chinese wall built between the junk team, the not sub-investment grade team, and the equity side, because they had information through their financing of what was going on, and they weren't allowed to talk across the Chinese wall. Some people can argue whether that's been successful or not. That's for somebody else another day, but that's how it used to be done.
Yeah, there are still Chinese walls in equity markets between corporate financiers and equity investment managers or equity salespeople.
They're quite porous, though, aren't they?
Yeah. I'm not saying
concrete's not the best.
It's silly crumbled, as is the Chinese Great Wall of China in many places.
So, Chris, you've now seen the portfolio
Yes.
live in front of your eyes. What would be the attractiveness of adding corporate bonds to a portfolio?
Yeah, well, this is where I'm going to actually bang the table at risk of getting a red card here and saying, come on, guys, why have you got short-dated gilts? Yes, they have defensive characteristics. I can give you similar defensive characteristics, but some more lovely income every year. You can have short-dated investment-grade corporate bonds. These are high-quality companies like Vodafone, like Tesco we talked about earlier. I can pay you 1.5% more per year, with very similar capital risks. Now, we talked about compounding earlier in the series. The compounding power of that income over many years is going to make a huge difference.
And when you say short dated, you mean, just for the benefit of our listeners, when we first explained, we talk about something up to 5 years maturity. Is that what you're defining
That's
as
how
well?
I would define it, up to 5 years. Because
so what you're saying is high quality, short dated corporate bonds. So you're talking about names like Next, BP, whatever. You can pick up 1%, maybe 1.25%, maybe above the government rate. So if you're happy buying those shorter dated bonds in the government market, why wouldn't you be happy buying them in the corporate market?
Exactly. And in today's market, you're getting about 1 to 1.5% more. But sometimes you can get a lot more. If we wind back to the Liz Truss era, you were getting 3% more for high quality companies, even for only up to 5 years of maturity.
Isn't that the point? The point is that when there's a bit of a crisis, when something goes wrong, allegedly Liz Truss caused a crisis. We haven't yet got to the episode where we discuss Liz Truss, but that will come at some stage.
It's coming soon.
Because of what she did and the way the markets reacted and started to panic, that then led people to worry about whether there was going to be a recession coming into the UK. And because they're worried about recession, these corporate bonds went to yields that became more attractive, i.e. they gave an income level much higher because people were wondering whether they were actually good to pay their dividend and their income. Is that right?
Absolutely. You've nailed it, really, that you get paid more income because you are taking a little bit more risk. Now, with shorter dated high quality companies, that risk, I would argue, is very manageable. Even with the Liz Truss scenario, Tesco is not going out of business over the next 2 years. You can argue about over 20 or 30 years, maybe they're going to have a deteriorating business and therefore their yields should go a lot higher. But over 2 years, people are still going to be buying food and Tesco are still going to be making good profits.
I suppose the point I'm trying to make is it not better to wait for that crisis period, then buy your short-dated corporate bonds, than having a long-term holding in them? What's your feeling on that?
So it really comes to a concept of interest rate risk, and the longer dated a corporate bond is, the more sensitive its price is to a change in yield. My argument would be own short-dated credit through the cycle, because even when the yields rise, the capital losses are so small that your income is more than compensating you. But if you buy longer-dated corporates, your timing is very important, because if you buy at the wrong time, you could face substantial capital losses. If you wait till they're cheap, then you could enjoy those capital gains on top of income for many years.
Okay, so that's clear. So you're saying for the shorter dated corporate bond market, although they will move around in terms of how they trade, net over time, the turnover of the cycle will be great. Longer term corporate bonds, you've got to be a bit more careful about when you do that. Okay.
Exactly. But there can be years when government bonds substantially outperform, such as 2008. Government bonds were up maybe 13% that year. High quality corporates were down 10%.
Wow.
But in most years, on average this century, you've had 1.5% more per year from high quality corporates.
I remember that year very well, because that was when I started at one of the firms, and I started working with Chris, and we had to go to see the life company investment committee because they saw our performance and it was so dreadful on that year, because in that year equities had done pretty badly. Government bonds had done really well, but corporate bonds had done quite badly. Then, of course, the government came in and rescued the financial system, and suddenly all those corporate bonds were suddenly money good again, and everyone was very happy. So actually, it was a very good ending to the story, just a little bit nervy in the middle.
So in a recession, obviously, you would expect the difference between government bond yields, the price of the interest they would pay on government bonds, to corporate bonds. Corporate bonds would have to pay more interest to borrow money. So is there a time at the moment, obviously, that the difference between that has been shrinking and shrinking and shrinking, because we haven't had a recession for quite a long time now? Is there a point they get to a level where you think, oh, that's just mad, because I can borrow money off of a government that is guaranteed not to go bust effectively, or a company that even in 20 years might or might not, but you get the same interest of both? Is that when you start selling your corporate bonds?
Absolutely right, Spice. So this difference between the corporate yield and the government yield is something called the spread. And the spread is tradable. You want to buy corporate bonds when the spread is wide. You want to sell corporate bonds when the spread is tight. Today's markets, the spreads are very tight, the tightest they have been since the great financial crisis in 2008. So in my portfolio, I'm quite defensive in terms of my credit exposures. I have very short-dated credit. I have only 2% in high yield. That's a very low weighting historically. And my measure of interest rate risk, which is called duration, I've kept that very low because I think there is a risk that spreads widen. We are not expecting a wave of downgrades and defaults, but mark-to-market risk is here because we live in a more volatile world.
Anna, that's an extra term that we've just brought to the listeners for the first time, duration. Do you mind giving us a little bit of a beginner's guide explanation to duration?
Of course, duration is just interest rate risk. And what it really means is the higher the duration of a bond or a bond portfolio, the more the price of that bond changes for a given change in yield. So if yields go up everywhere by 1% across the yield curve, the bonds with the higher duration will have bigger capital losses. So sometimes you want that. If you think yields are going to fall, you want lots of duration in your portfolio because you'll get the income and you'll get a capital gain. But if yields rise, you can have a capital loss. And if the duration is high enough, those capital losses could be more than the income.
So a little bit if a butterfly flaps its wing, then the reverberations out the amount of time are much greater than at the
I think that's quite a good analogy. Maybe not so much time, but maybe distance. You know, if you're close to that butterfly, it doesn't move. It doesn't have a chance to move much. If you're a long way away, all the other effects from flapping those wings might have a bigger effect on you because you're that much further away. So the longer the maturity, the higher the duration generally. And the higher duration means a greater sensitivity in capital terms to any change in yield. So as Chris says, if you're really optimistic about interest rates falling and bond yields rallying, and bond yields falling, as we said before, you want a long-dated bond because it's got lots of duration and it will move in capital terms very quickly for those movements in yield. If, however, you are more defensive, if however, you think that bond yields might rise, you want a short-dated bond, the bonds that Chris was talking about, those 0 to 5 year bonds, you want those bonds because even though yields might go up, you won't lose much capital. And so that's one of the key points.
And because it's a number, you can actually use it to predict gains or losses. So if the duration of a bond is 20, that means you will make or lose 20% if the yield rises or falls by 1%. So short-dated bonds typically have a duration of maybe 2 to 3. Long-dated bonds might have a duration of 12, 15. So you can see that you're talking 6 or 7 times the volatility for the same movement in yield.
The companies that we've mentioned so far have all got equities as well. They don't have to have equities to have corporate bonds, do they? I've seen ones in Heathrow Airport, John Lewis.
Exactly. That's one of the benefits of the credit market. You get access to more companies than you do through public equity. But if it's a private company, it might take you more work to actually get under the skin, find out what's driving the company, what's their leverage like, what's the business prospects like. So you have to do more work, you have to do more analysis.
If it's a listed company, there's quite a lot of information available on it. If it's a private company, there isn't. So you've really got to then earn your spurs with your credit department to really work out what the prospects of that company are.
Absolutely. And because with corporate bonds, you can lose everything if there's a default, I would always say you need to meet the company. You need to stare into the whites of their eyes, find out what's driving the business. Can you really trust these guys to pay their coupons every year and pay your principal back in 5 years or 10 years?
But if there is a default, would the equity naturally have gone to zero?
Sometimes, but you do have some strange cases. For example, Credit Suisse just a couple of years ago, where bondholders ended up losing everything and equity holders got paid.
They only lost 99%. Sorry, we.
They got taken over, didn't they?
They did.
Was that before or after you?
I was out there in 2016, saw the writing on the wall, you could say.
So it wasn't your trading that made them vulnerable.
That's a different story. What about the characteristics then? How do corporate bonds fit into a portfolio and when's the right time to have them and not to?
Great. So I think they should be a core part of everyone's portfolio, but I'm really talking about investment grade. These are high quality companies that are very unlikely to default. And once you get into the weeds of finance, they produce a very high risk-adjusted return. That means you're getting a nice coupon every year with very low price volatility. So something called the Sharpe ratio is very high for corporate bonds. And going further, they touch something called the efficient frontier, which means for that level of risk, there is nothing that pays you a higher return. So in my personal portfolio, I own a lot of corporate bonds, mostly short-dated at the moment because of the risks that Spice was talking about. in my pension, I own longer dated corporate bonds.
Can we, sorry for a bit of translation, Sharpe ratio and efficient frontier. So the Sharpe ratio is the return per unit of risk, essentially. So what you look for in an investment is something that gives you a lot of return for as little risk as possible. And that's where your Sharpe ratio comes in. Your efficient frontier is when you look at the return you might get off various asset classes, from equities to bonds to property to private equity, whatever, and you plot that against the risk that they are, and you work out what the right proportion should be of each of these to give you the optimum trade-off between risk and return. And that is your efficient frontier. So in theory, and remember, this industry is great for theory. Plenty of time when you look at that theory, you see it's completely blown up, but we'll do that another day. In theory, you want to be somewhere on that efficient frontier. You want to make sure your asset allocation is consistent with your expectations for risk and return. And where we have that ourselves, we haven't done the efficient frontier, but where we're doing ourselves is if you look at our portfolio in how much we hold in various types of assets. We, in essence, are thinking about what return are we going to get on each asset, what risk they offer, and then deciding how much we should have of each to be the best place to put our money.
My analogy of a efficient frontier would be when you go out on a Saturday night and how many drinks you have to have the peak evening, because we all know, Spice, that we take it too far.
How rude. Where is the HR department?
Your chart of the evening might suddenly tail off quite badly.
And exactly. And so I would say corporate bonds are a bit like James Bond would say, and one's not enough and three's too many.
So, Chris, you've explained about what investment grade and junk bond or high yield corporate credits are, but tell me about the structure of the overall corporate bond market, because I seem to remember in the days of old, it was full of oil companies in the junk bond area and full of financials in the investment grade. Has that changed much? And is it UK based or do you invest internationally?
It's global. It's the biggest capital market in the world. We focus globally, but we have a lot of investments in the UK. And if we look at, say, a UK representative credit portfolio, it would be about 1/3 in banks, perhaps 10% in insurers, so maybe 40% in financials. And they tend to be higher beta. They tend to have higher yields as well. Often very attractive opportunities. Beta is a measure of market risk. So they tend to move up and down with the market a bit more aggressively than more defensive, like non-financial bonds do. So an oil company, for example, tends to be quite defensive. They've got inelastic demand. They do well in good times and bad times for the economy, whereas financials can be quite tied to the health of the economy. So financials are about 40%. You then have non-financials like Vodafone, like BP. In utilities, telcos are big issuers. You have some property companies. They can issue secured bonds where you can buy bonds that are physically backed by some properties. We also have things like train companies, for example, media companies. So basically you can buy every sector that exists in the stock market.
But the biggest sectors are financials.
Yes,
still.
That's right. Now, if we go back to 2008, they were the biggest losers. Since then, the regulatory environment has changed so much that capital ratios of banks are far better than they ever were. They're essentially utility-like businesses now instead of growth businesses. That makes their bonds much higher quality than they used to be, and actually a fantastic source of return. And they still trade cheaper than non-financials because they are a bit more economically sensitive. So we really like financials in our portfolio at the moment. But we're talking UK banks here and building societies. Things like Nationwide in Coventry. I can buy their bonds. They're paying me 6.5% per year. That's a great return in this environment.
And what maturity would those bonds be?
3 or 4 years.
3 or 4 years, wow. That's good, yeah.
And you say that it's not just the UK investing. How big is the rest of the world, America, compared to...
America's the biggest. It's about half of all global fixed income credit indices. The UK is quite small. We're actually about 8% of a global index.
It's bigger than our equity market. It's only 3% the equities.
Yeah, and Europe's a big part of it. Asia's a big part as well. So basically, certainly in developed markets, which is my focus, every country issues bonds.
You've been a portfolio manager for a long time, Chris. One of the things we want to start asking all our guests when they come in is what lessons have you taken from the market which might be useful for our listeners? Is there one or two that you can sort of describe maybe how you've learned it and what the lesson is?
Absolutely. I'd say the number one for me is liquidity. And what I mean by liquidity is the opportunity, the ability to sell the bonds that I don't want to own anymore because I might change my mind on the company or the government. I'd say before the financial crisis, we took liquidity for granted. It was very easy to sell government bonds and corporate bonds. Through 2008, it was very difficult. Sometimes it was physically impossible to sell corporate bonds. Since then, we've taken a different approach to liquidity. I believe you have to manage it through the cycle, which means, generally speaking, you always need to have some very high quality bonds in your portfolio, some near cash-like investments. And also, I like very short-dated bonds that are going to mature in, say, the next 3 or 6 months, because I get my principal back. That gives me additional liquidity.
It's interesting. So your thought there would be that you need that liquidity. So that really links me nicely into another question that I've got, a little pet subject of mine, and that's private debt. Now in private debt, presumably, there isn't any liquidity in anything. You once in, you're in. And that's it. What's your sort of thoughts on that?
Absolutely. And I'm a public markets guy. I like liquidity. I like having the option of at least being able to sell something in the future if I change my mind. You don't have that with private credit unless you can find another investor who's willing to take it off your hands. So the quid pro quo is you get paid a higher coupon, a higher yield. But as the market has rallied over the last few years, the additional premium you get for that illiquidity has become quite small. And that's when I start getting nervous.
So what you're saying there is that, in just using the parlance we were using earlier, the spread that you're getting on private debt or private credit, you call it private credit, I call it private debt, it's exactly the same thing. The spread you're getting used to be a lot higher than the spread you would get on investment grade bonds in the liquid markets. The problem is, with so much money in going into credit markets now, both those spreads have fallen. It's become more expensive. The investment grades have become more expensive, but so has the private debt. But the private debt, there's no liquidity in that at all.
That's right. That's one major problem. The other problem for me is lack of transparency. Now, I'm not saying, there's plenty of good private credit out there, but there could be private credit structures where there's credit deterioration happening. Some of the underlying bonds are not performing. And that might mean that maturities are being missed, or that coupons are being missed, or that coupons are being rolled into ultimate principal called PIK or payment in kind structures. And if there's transparency, that's great. The investors are aware of that. If it's opaque, they might not be aware of the deterioration that's happening in the underlying instruments. Whereas in public credit, you're marked to market every single day. The price of those bonds is publicly visible. There is no hiding place for volatility.
So take us through that in a bit more detail. Sorry.
Yes.
So if there's a problem on paying the coupon, rather than defaulting, of course, which is the worst possible option, there's negotiations that go on. And what happens?
It's effectively kicking the can down the road. It's saying, instead of paying us the principal back in 3 months' time, let's push it out for 5 years or 10 years to give that company an opportunity to grow itself out of the problem, or possibly help them refinance some loans from elsewhere, maybe from a bank, maybe having an equity injection. And ultimately, that means you hold on and getting your return short term. You don't get the cash flows now. You will possibly get them later, maybe with a higher implied yield, but there's more risk there, of course.
So that is, in my book, an effective default. Putting it into my simple language, you bought a bond, you knew you were getting your money back at X date in the future. As you approach X date in the future, you've got that all sorted, you were expecting that money back, you know what you want to do with it, blah, 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 blah. You suddenly then get phoned up by someone saying, sorry, can't afford to give you your money back. But hey, what we can do is we could extend the life of this bond to 30 years. So rather than being a 1-year bond at this stage, because I'm getting it back next year, it's now 30 years' time before I get it back. And you can imagine that the confidence that I'm going to get back in 30 years, having not got it back in 1 year, is not going to be high either. So I've actually got probably a worse instrument, and I've effectively been defaulted on.
We saw First Brands, obviously. We've touched on that, and Tricolor as well. Do you see credit deterioration anywhere else in the market?
No, this is the bizarre thing. From a public markets perspective, no, we are not seeing downgrades. In fact, what's called fallen angels, which are bonds that were formerly investment grade but become high yield if they're downgraded, essentially at all-time lows. Defaults in investment grade are zero at the moment, have been for the last year. and think, well, that will continue. So we're not seeing deterioration in public credit, but we do think there's a problem with the US auto sector. Auto loan delinquencies are at all-time highs, higher even than 2008. So I think clearly there are parts of the US consumer market where rates have gone up a lot, the cost of new cars has gone up a lot, they are struggling to make those monthly payments.
In fact, we talked about that last week, and I noticed Fitch this week have obviously highlighted that the auto side is getting very dangerous.
Horse door bolted.
Here we come. Richie's back. Richie's back to the
Thanks to rating agency.
bear market.
I think it's all these cockroaches obviously driving around in cars they can't afford.
Chris, tell us a little bit more about the fund that you run then.
So I run a range of funds, but my most successful fund is my short-dated fund. And it's such a strong producer of high-quality returns with low volatility, we actually call it absolute return. Not that we're promising you'll make a positive return every single year, you mostly do, but generally speaking, over a reasonable horizon of 3 years, you tend to always make a positive return. We focus on BBB rated bonds within that. That's the lowest rating band within investment grade, but it's still very high quality companies like Vodafone, like National Grid, like Scottish and Southern, where you're getting paid 5-6% coupons a year. If we have a couple of rate cuts, we might be able to get a little bit of a capital gain from these bonds as well. The jury's still out on whether the Bank of England may cut later this year, but maybe next year we might see 1 or 2 cuts from the Bank of England. That should help short-dated bonds as well as the nice income that you get with low capital risk. It's called the 24 Absolute Return Credit Fund.
And absolute return, that means you're not guaranteed that it will go to less than zero, but that absolute return means that it shouldn't go to less than zero.
It shouldn't in most years.
Yeah.
I'd say 1 year in 20, you could expect it. 22 was that year when we had base rates going up by hundreds of basis points. The Federal Reserve hiked rates by 450 basis points. Even that was enough to dent the returns from short-dated credit, and they had a slight loss.
Chris, that's been really fantastic. But I think before we say goodbye, we need to get your thoughts on the budget. And I've got two questions on the budget. The first one is, what do you think the bond market actually wants from the budget? I mean, there's all these people talking about what it wants, but what do you think as a market participant, somebody who's in it the whole time? What do you think it wants? And more importantly, what do you think it's going to get?
Great question. I think what it wants is budget deficits that typically are 3% of GDP or less. Currently, we have a budget deficit that's worse than 5% of GDP. That is unsustainable. So I think the bond market wants public finances to be in order. They want spending and revenues to be broadly in line. They can tolerate a 2 to 3% deficit because you can grow your way out of that. When it becomes more than 5, that starts being a problem. That was really the issue with the Truss mini-budget chaos, because there weren't spending cuts announced, but there were tax cuts announced, and effectively the public finances were going to get worse. So I think the bond market will be happy as long as we have a stable position where revenues are going to be broadly in line with what the government's spending. What we're actually going to get, I fear, is no cut in spending and further tax hikes. And I know Arthur Laffer has been in the UK recently saying his Laffer curve, in his view, and I agree with this.
Just mention what the Laffer curve is.
The Laffer curve is a theory that you can't keep raising tax revenue by raising tax rates. There comes a point when you raise tax rates beyond a certain point, ultimately you bring in lower revenues the next year because you've hurt growth or you've had investors flee the country, for example. So I think we are now at that point where taxes are so high that even a small rise in taxes could dent growth enough that tax revenues ultimately fall next year.
What you're saying is no public spending cuts. Yes, lots more tax rises. Do we all live happily ever after, or is there an issue there?
I personally fear that we're going to see weaker growth next year. I'm not going to use the R word yet, but I think productivity is not great in the UK. In fact, it's just been revised lower. And therefore, we are flirting with an anemic growth environment for the next few years. It's going to be tough for companies to really make lots of gains in terms of profitability. There's going to be harder credit conditions, meaning banks will be less willing to loan money. And that should mean a slowdown in the overall economy, which means I need to be worried about credit spreads widening a little bit.
So are you taking any measures in your portfolio ahead of the budget? Are you anticipating this, or do you rather wait and see exactly what happens and then react? How are you managing that?
We've actually already become defensive. So we have no cyclical exposures in the portfolio. We have no high street retail, even as much as I like Next. We don't currently have any exposure there. And we're keeping what's called our credit spread duration very low, which means I'm minimizing my sensitivity to changes in credit spreads in the portfolio. I'm still trying to maximize the yield by buying shorter dated high quality bonds like banks, for example. I can buy 2 or 3 year bonds at 6 to 7% yields. That's going to protect my capital and give me a good income. But I've dialed down the longer dated bonds that might potentially have more losses.
And do you ever own cash in any large size?
Typically not. We have 2% in cash at the moment. What we often have is very short dated government bonds. So I have some US Treasury bills at the moment instead of cash.
And what kind of percentage of US Treasuries?
I've got 7.5% in Treasuries, but some are 5 years and some are T-bills. I've got about 2.5% in T-bills and about 5% in 5 years. A T-bill is a very short-dated bond. It's a bond that matures within the next 12 months. And they're cash-like because the price is very close to 100 and it hardly ever deviates from that.
So the last question we've asked before to people, another one of our stock questions. If you look at our portfolio up there, what would you do differently?
So I would bang the table here and say, come on, guys, what are you doing? You've got 0 to 5 year gilts. Now, they are defensive. They've made you 1.2% so far from inception. If you'd had the same maturity, high quality corporates, you would have had double the return. If you'd had 1 to 5 year investment grade, you would be looking at 2.5%. If you want your compounding return over the years, but still want those defensive properties, I think IG credit is your best bet.
So to finish off then, one last question. We call this podcast The Art of Investing because, behind all the theory, behind all the science, the three of us have seen enough in our careers to know that some of it is real down to the art. First of all, would you agree, Chris? And what would you say that some of that artistic merit is?
It's a really great question. There's always this debate, isn't there, between art and science. Coming from a programming background and being a numbers guy in the bond market, I tend to like hard numbers. For me, the times in my career when I've been most proud is when I've gotten nervous. I've had an intuitive feel that things are going to get really bad. I've gone defensive and then there's been a crash and I've managed to protect capital. So for me, the art is recognizing when your risk feelings are starting to get too high and you start to take corrective action.
That's a very good answer to me because I think that sums it up completely. There's a lot of analysis you can do, but sometimes you just got to think, is now the time?
Intuition and experience.
Sometimes it is and sometimes it isn't. If it isn't, you don't tend to have a reputation. If it is, you do very well in life. We'll see what happens to our reputation over the next week.
Fantastic. On that note, thank you very much, Chris Bowie, for joining us. And thank you to you for listening, making it all the way to the end of the podcast. If you have any questions for us, please hit us up on the email. And that is, gents,
theartofinvesting@ig.com.
We'll see you next week. Thank you for joining.